Take a look at Treasury yields right now. Look at the 10-year. Look at the 10-year, 4.1, the 2-year, 3.6. People are not totally rattled. Joining us right now, Kelsey Berro, fixed income portfolio manager at JPMorgan Asset Management. Are you surprised, by the way, that the bond market has not been more rattled by just everything?
I'm not too surprised. I think that there's been a fair bit of data, even though there's been a lack of official data with the government shut down.
Right.
And so, we're seeing corporate earnings. Those are going well. The economy seems to be chugging along. The Fed is supporting the market by cutting rates gradually. So I think we're in a bit of a range-bound environment as it relates to yields. So the range that I see for the 10-year, 3.75 to 4.25. We were a little bit below 4%. Now we've moved back above it. There's a bit of uncertainty around if the Fed is going to follow through with the rate cut in December. We think that they ultimately will.
So hold on. So you think So you think when you heard Jay Powell just a couple days ago, 2 days ago now, say that, there's a lot of dissension on the board. That was the first time he's really sort of been as clear about the debate that seems to be happening. But you say it happens anyway.
Right. So here's a couple of reasons why I think so. So there's a difference between what he said in the press conference, which in that case, he's representing the wide range of views on the committee. And clearly, those views have become more polarized in terms of the group that thinks that maybe we don't need to cut anymore versus the group that thinks we need to continue to cut rates to support the economy. But when I look at the statement, the forward guidance in the statement was actually completely unchanged. And then when I think about where does Chair Powell, who's ultimately the most influential person on the committee, where does he sit in terms of his forecasts? And I think back to where he was probably in the September dot plot. He was probably within the median of the committee that expected 3 rate cuts this year, which would imply another rate cut in December. And I look at the data we've gotten since September, and I don't see any reason why his view would have changed. We did get the September CPI despite the government shutdown. That came in weaker than expected and in the right areas. Okay. So in terms of service inflation cooling, while we saw some heat in core goods, but that's kind of known because of the tariff impact. And then you look at some of the labor market data. We didn't have the jobs report, but we did get ADP. That came in negative for September. And some of the more high frequency data that we look at, it's not falling off a cliff, but it is continuing to gradually cool. So I actually think those who are in the median of the committee, their view has probably strengthened that they're on the right path.
Where are you on what you think inflation really looks like in this country right now and what you think unemployment or employment looks like in this country right now? And what tools and levers do you actually think the Fed even has at this point with some of these things?
Yeah, so it is a challenge. I feel like we throw around the idea of a K-shaped consumer, K-shaped businesses a lot, but it is really a reasonable way to describe what's going on. Everyone's experience with inflation is different. We have one aggregate measure or two aggregate measures, CPI and PCE. The Fed prefers PCE. They're both telling you that excluding tariffs, inflation is pretty close to the Fed's 2% target, but obviously the average person's basket is different than an individual's basket of goods and services. And so everyone is experiencing inflation differently. And we do know that while inflation may on paper, excluding tariffs, look close to 2%, that consumer sentiment is still very poor. And a lot of that does have to do with dissatisfaction about cost of living and the cost of things because wage growth has been slowing and it's not necessarily keeping pace with the goods and services that people need.